Silver didn't crash because it failed. It crashed because someone needed it to. While your screen bled red, Shanghai was paying nearly $90 an ounce. So ask yourself, who was selling and who was desperately buying? Ladies and gentlemen, while I am here, the screen erupted in crimson. Not with warning, not gradually, but violently, instantly, like blood flooding through digital veins. Silver didn't decline, it plummeted, it cratered, it evaporated. Within a single trading session last week, the price hemorrhaged several dollars, obliterating weeks of painstaking gains in mere hours. Red candles plunged downward, like daggers piercing through support levels. Alert notifications screamed across devices. Stop-loss orders detonated in rapid succession. Leveraged positions exploded into dust. And immediately, the digital airways ignited with panic. Social media transformed into a frenzied echo chamber, the same desperate words reverberating endlessly. Manipulation, crash, collapse, catastrophe. Something fundamental had shattered. As of this moment, Thursday, January 8, 2026, at precisely 5:26 p.m. Eastern Time, silver trades at $77.98. That represents a brutal $3.06 hemorrhage from yesterday's closing price of $81.28. We're languishing nearly $4.60 beneath last week's triumphant peak of $82.58. Yet here's the invisible truth buried beneath the carnage, the secret nobody dares whisper about what genuinely transpired. Here's the singular question, demanding an answer before you dare touch your silver position with trembling fingers. If silver truly imploded due to deteriorating fundamentals, why are Shanghai buyers frantically paying $14 premium per ounce over New York's printed price at this very moment? Why do physical premiums remain stubbornly, defiantly elevated? Why did vaults document massive, unprecedented withdrawals immediately preceding this supposed collapse? Today, we're dissecting exactly what unfolded. Not the manufactured panic narrative, not the orchestrated broker hysteria, not the weaponized fear. We're examining the precise mechanical trigger that detonated this movement, identifying who possessed advanced knowledge, and revealing why the savage selling you witnessed marked the conclusion of something profound, not its genesis. Because what materialized on your screen wasn't truth, it was theater. The market wasn't revealing reality. It was purging positions, hunting stops, flushing leverage. And the essential question burning through this moment demands asking. Who desperately needs you to believe this crash represented genuine market discovery? The phone calls didn't originate randomly, scattered across time zones and trading desks. They erupted simultaneously, a coordinated avalanche. Clients spanning different brokerage houses, different continents, different account magnitudes, all receiving identical urgent messages within the same compressed window. That synchronicity alone should freeze your blood, because brokers don't operate this way organically. They don't orchestrate coordinated urgency unless someone far upstream, someone wielding enormous influence, commands them to act. They didn't suggest caution with phrases like "we anticipate a pullback," or "this might consolidate temporarily." No, they deployed apocalyptic language, meltdown, structural liquidity event, systemic risk, guaranteed, cascading liquidation. They recited from literal scripts, word for word identical phrasing echoing across firms and continents. The tone carried rehearsed precision, superficially calm, yet urgently pressing beneath, wielding just enough institutional authority to bypass rational skepticism. Then came the truly revealing directive, not merely to harvest profits, but to aggressively establish positions betting against silver. Put options, inverse ETFs, extreme downside protection. They were actively counseling their own clients to wage war against one of the decade's most explosive performing assets at the precise moment when fear reached its crescendo. That transcends risk management. That is positioning, deliberate and calculated. Pause and confront the only question that genuinely matters in finance. Since when do massive institutions broadcast warnings before genuine collapses? They remained silent when silver languished forgotten at $20. They offered no alerts when analysts openly mocked it at $15. They issued no warnings when it shattered through $50, humiliating every bear. But now that silver has already delivered staggering returns, now that inventories constrict visibly, now that physical demand becomes undeniable, suddenly they've discovered profound concern for your financial safety. When they're screaming at everyone to sell, ask yourself with brutal honesty, who is positioning to buy? The answer isn't mysterious or complex. They are. These urgent calls aren't warnings. They're invitations, carefully crafted solicitations for you to provide desperately needed liquidity at precisely the moment when liquidity has evaporated. Someone significant is trapped, suffocating on the wrong side of this trade. And when large players find themselves ensnared, they don't panic publicly on financial television. They manufacture panic privately, weaponizing fear, deploying institutional authority, introducing narratives that sound technically sophisticated enough to feel mathematically inevitable, yet remain vague enough to evade serious scrutiny. That narrative possesses a name, a bureaucratic event, a calendar trigger, a supposedly unstoppable force. They inform you it's approaching. They insist it's mathematical certainty. They declare it cannot be avoided or mitigated. But here's the detail they carefully avoid emphasizing, because it demolishes their entire story. If this event truly carried catastrophic weight, if the selling were genuinely sudden and unavoidable, if the outcome were truly guaranteed destruction, they wouldn't be calling you. They would already be done, positions closed, damage contained. Markets don't issue advance warnings of authentic disasters. Genuine catastrophes arrive unannounced. What the brokers reference sounds technically sophisticated enough to silence questions. They call it the rebalance, a cold, bureaucratic phrase stripped of emotion, devoid of opinion, merely rules executing as written. That's precisely why it functions brilliantly as psychological warfare. When fear wraps itself in mathematics, people assume it's unavoidable destiny. But understanding what's actually occurring requires stripping away theatrical drama and examining the machine they're invoking. At the epicenter of this narrative sits the Bloomberg Commodity Index. To most investors, that name registers as meaningless noise. But to institutional capital, pensions, endowments, sovereign wealth funds, it's foundational infrastructure. The BCI doesn't analyze supply chains, doesn't monitor geopolitics. It doesn't care about mine closures, solar demand explosions, or vault inventory levels. It represents blind capital, a passive system engineered to hold a commodity basket according to rigid rules written years ago, rules enforced automatically without discretion. Once annually, those rules force action. Every January, the index executes a rebalance, examining each commodity's value and resetting weights back to predefined targets for the new year. Not because something's fundamentally wrong, not because supply-demand dynamics shifted, but because the calendar turned. Here's the critical insight most people miss entirely. The index doesn't rebalance based on opinion or analysis. It rebalances based on relative performance mathematics. When one commodity dramatically outperforms, surging far beyond others, it expands disproportionately inside the portfolio. Its allocation slice grows, and the rules say no single commodity can dominate. So the index mechanically trims winners, not because they're weakening, but because they're too strong. Silver was one of those explosive winners. Throughout 2025, it didn't merely rise, it detonated. While other commodities stagnated or drifted sideways, silver rocketed over 120%. As the price climbed relentlessly, its weight inside the index ballooned far beyond target allocation. By year's end, silver wasn't sitting quietly at its assigned percentage. It had become grotesquely oversized, triggering the automatic rule. For the new year, the index committee lowered silver's target weight. On paper, the adjustment appears minor, a fraction of a percent. That's the number brokers love quoting because it sounds harmless, technical, utterly manageable. But that number is deliberate misdirection, because the index doesn't rebalance from last year's target. It rebalances from current reality. And reality had transformed dramatically. By the time the rebalance window arrived, silver's actual weight inside the index towered far above the new limit. The required action wasn't a minor trim. It was a massive reduction. To comply with its own rigid rules, the index had to liquidate a substantial portion of silver exposure, not gradually over months, but within a defined, compressed execution window. That's where the terrifying dollar figures originate, the ones whispered ominously on broker calls. Billions in forced, mandatory selling. Here's the element that triggers panic. The selling is non-negotiable. The index cannot delay, cannot claim unstable conditions, cannot exercise judgment. When the rules command selling, it sells. No discretion, no mercy, no exceptions. This trigger wasn't a surprise ambush. The rule was publicly known. The new target weights were published months earlier. The mathematics were available to anyone willing to calculate. Professional traders saw this approaching long before phones started ringing with urgent warnings. Which transforms the question fundamentally. It's no longer about what is being sold. The real question becomes, when was it sold? If this selling were truly sudden and unexpected, price wouldn't have warned you. It would have collapsed without explanation. No whispers, no preparatory calls, no time to react. That's how genuine shocks behave. They arrive without warning. But this wasn't a shock. The rebalance didn't materialize from nowhere, wasn't discovered last week in some hidden document. The new target weights were published months in advance, in plain sight, long before markets started convulsing. And professional money never waits for execution day. Waiting is considered malpractice because when a forced seller becomes publicly identified, the trade begins immediately, not when rules mandate completion, but the moment everyone knows it will occur. This is structural front-running, not illegal front-running, but anticipatory positioning, the silent repositioning occurring every time a passive index faces forced movement. Active managers don't passively watch calendars. They move early, selling into strength, using rallies as camouflage, letting eager buyers absorb their exits without ever realizing distribution is happening. That's exactly what occurred here. Examine the weeks preceding the crash. Silver didn't accelerate through resistance, the way genuine shortage markets typically behave. It stalled, hesitated, struggled. Every upward push meant mysterious supply appearing from nowhere. That wasn't coincidence. That was professional distribution. November and December weren't quiet consolidation periods. They were exit ramps, carefully orchestrated distribution phases. The same institutions, now warning you about imminent danger, were already methodically lightening positions. While price remained elevated and enthusiasm ran strong, they weren't selling in panic. They were selling professionally, slowly, methodically into available liquidity. By the time the calendar flipped to January, most heavy lifting was already complete. Index tracking funds with flexibility sold early. Hedge funds anticipating the rebalance sold early. Dealers adjusted inventory early. So when the official rebalance window finally opened, what remained? Only the strictest passive funds, the ones legally prohibited from early action, the ones that must trade on the designated date regardless of price. They're smaller, slower, and utterly predictable. That final selling wave, the one you actually witnessed exploding across your screen, wasn't the main event. It was the echo, the aftershock, arriving once the real earthquake had already passed. But here's where the deception locks into place. If the worst selling already occurred quietly during distribution, then the catastrophe narrative collapses. The disaster moves from future threat into past event. Unless they need you to mistake the echo for the explosion, to see passive selling and believe it's the beginning rather than the conclusion, to panic late after smart money has already repositioned. Once prices started moving with sufficient violence, intent became irrelevant. The market stopped asking why and began ruthlessly enforcing rules. This is the moment when human decision-making surrendered control to machines. Silver didn't fall because someone woke up bearish or fundamentals deteriorated. It fell because thresholds were crossed, because risk models illuminated warning lights, because leverage became instantly illegal overnight. This is the paper flush, the mechanical purge. In the futures market, most positions aren't owned. They're rented. Traders control massive silver amounts with minimal capital. That functions beautifully when prices remain stable. It becomes lethal when volatility spikes. And volatility didn't just spike, it exploded. As silver dropped, clearinghouses responded the only way they know, raising margin requirements. That single action changes everything, because margin isn't negotiable. If you cannot post additional collateral immediately, your position is closed. Not tomorrow, not later, now. No debate, no discretion, no appeal. Traders who were correct on fundamentals, but wrong on timing, were forced to liquidate. Not because they changed their analysis, but because the rules demanded it. This is why crashes feel irrational and inexplicable. People assume sellers are making considered decisions. They're not. They're being liquidated, forcibly ejected. Every forced liquidation pushed price lower. Every lower print triggered more margin stress. Every margin call produced more selling. A vicious feedback loop formed, self-reinforcing and accelerating. Simultaneously, stop-loss orders fired automatically. Algorithms detected momentum and amplified it aggressively. High-frequency systems don't question whether silver is scarce or abundant. They see velocity and direction, and they pile on ruthlessly. This is how a mechanical rebalance transformed into a violent flush. The selling became self-perpetuating, and from outside observation, it resembled complete collapse. But here's the critical distinction most people never grasp. Volume is not supply. What was trading frantically here wasn't metal. It was paper promises. Futures contracts representing claims, not physical bars. Millions of ounces changed hands digitally, without a single physical bar moving an inch. That's why price can plummet even as vaults empty. That's why charts can scream panic, while physical buyers calmly wait. The paper market is engineered to absorb stress by expelling the weakest participants. It clears leverage, punishes overextension. Once the flush begins, it seeks the lowest price that will force maximum capitulation. While the paper market was convulsing violently, something far more significant was happening quietly, almost invisibly. And almost no one watching charts saw it unfolding. Silver was disappearing, not metaphorically, but physically vanishing. As futures contracts cascaded lower in New York, buyers elsewhere stepped in decisively. Not with leverage, not with algorithms, but with cash and shipping schedules arranged. At the exact moment silver collapsed on Western screens, physical buyers in Asia were paying substantially more, several dollars more per ounce, for identical metal. Let me show you the numbers with precision. Right now, the Shanghai Futures Exchange front-month silver contract trades at approximately 20,450 yuan per kilogram. The mathematics are revealing. 20,450 yuan divided by 7 yuan per dollar equals $2,921 per kilogram. Divided by 32.15 troy ounces per kilogram equals $90.86 per ounce. Meanwhile, silver trades at $77.98 in New York at this moment. That's a $12.88 premium in Shanghai, nearly a 17% spread. That difference isn't noise or temporary dislocation. It is a scream, a desperate signal. In a healthy global market, price gaps of that magnitude cannot survive. Arbitrage destroys them instantly. Traders buy where it's cheap, sell where it's expensive, and equilibrium is restored. But this gap doesn't close, it expands. The cheaper the paper price falls in New York, the more aggressive the buying becomes elsewhere. The discount transforms into an invitation, a clearance sale on strategic material, and metal begins to move. Not electronically, not synthetically, but on ships crossing oceans. This is the moment when the abstraction of the paper market collides violently with the physics of the physical one. Silver can be sold infinitely on a screen, but it can only be shipped once, and once it leaves, it doesn't return. Every forced sale in the West makes the arbitrage more attractive. Every flush widens the incentive to drain vaults. The paper market thinks it is relieving pressure. In reality, it is accelerating depletion. This is why the price signal is lying, distorting reality. Because the futures market is clearing leverage, while the physical market is clearing inventory. They are solving entirely different problems. If the sell-off were real, if demand had genuinely collapsed, physical premiums would vanish. Buyers would step back. Inventory would accumulate. Instead, the opposite occurs. Premiums rise. Delivery delays lengthen. Vaults report outflows, not inflows. That tells you everything. The crash is not being caused by too much silver. It's being caused by too many promises. And the more violently those promises are liquidated, the faster the real metal migrates to the hands that value it most. The physical drain you're witnessing, the split between paper price and real-world demand, didn't happen by accident. It wasn't random, and it wasn't caused by traders making emotional decisions. It was written into policy, buried in the fine print of a sweeping trade action, a carve-out so precise that almost no one noticed it initially. That sentence lives inside Executive Order 14346. On its face, the order looks straightforward. A broad escalation of tariffs designed to punish foreign manufacturing. Finished goods entering the United States are hit with heavy duties. But the United States does not produce the raw materials required to rebuild its industrial base at scale. And silver sits at the center of that contradiction. Silver is not optional in modern manufacturing. Missiles don't function without it. Medical devices don't work without it. Modern solar panels absolutely cannot be manufactured without it. So when the administration drafted the order, they faced a hard constraint. If they applied tariffs to raw silver bullion, they would instantly cripple the very industries they were trying to reshore. So inside the annexes of the order, bullion-related articles were explicitly exempted from reciprocal tariffs. Finished products get taxed heavily. Raw silver does not. Zero. That single exemption changed everything instantly. Overnight, the incentive structure flipped. If you import a finished solar panel, you pay a massive tariff. If you import a raw silver bar to build that panel domestically, you pay nothing. That is not a loophole. It is a funnel. A legal vacuum designed to pull physical silver into the United States as fast as possible. And the moment that exemption became law, global buyers understood what it meant. The U.S. was about to compete aggressively for silver, not as an investment, but as a survival input for reindustrialization. Simultaneously, producing nations saw the writing on the wall. They saw a major consumer nation attempting to vacuum up raw materials while exporting inflation through tariffs. And they responded the way nations always do when strategic resources are involved. They tighten control. Export restrictions, strategic stockpiling, resource nationalism. Silver stopped being treated like a commodity and started being treated like infrastructure. That's why physical prices refused to follow the paper crash, because the law created a one-way door. Silver could move freely into tariff-free zones. But once it left producing regions, it was unlikely to return. The paper market doesn't understand this. It doesn't read executive orders. It doesn't model legal asymmetry. It trades spreads and momentum. But the physical market understands policy perfectly, and it reacted immediately. For decades, the silver market functioned on an unspoken assumption that delivery didn't matter. Contracts could be rolled, positions could be netted, losses could be settled in cash. Silver was traded like a number, not a material. That assumption is now failing because the buyers entering this market are not hedge funds chasing basis points. They are manufacturers, governments, and strategic entities that require metal, not exposure. The paper-silver market is built on leverage, on the idea that far more ounces can be sold on paper than exist in vaults. This worked as long as most participants never asked for delivery. But when demand shifts from financial to physical, leverage becomes liability. Short sellers are not simply betting on price direction. They are promising future supply. And every ounce that leaves Western vaults, every bar shipped east, every inventory drawdown increases the risk that those promises cannot be honored. This is why the brokers sound urgent, because the short position does not shrink when price falls. It becomes more dangerous. Lower prices encourage physical buying. Physical buying drains inventory. Drained inventory tightens delivery risk. The shorts need one thing above all else: time. Time for sentiment to turn. Time for panic sellers to reintroduce supply. Time for confidence in paper settlement to hold. The BCI rebalance gave them a window, a scheduled burst of selling they could point to, a narrative they could amplify. Not to end the bull market, but to survive it. Because if delivery requests accelerate while inventories are thin, the math stops working. At that point, price no longer clears the market. Availability does. And once a market reaches that stage, shorts are no longer managing risk. They are managing exposure to default. This is the pressure building beneath the surface, invisible on charts, but impossible to ignore in logistics. The crash was supposed to relieve it. Instead, it made it worse, because the metal didn't come back. Markets do not transition smoothly from one regime to another. They rupture, not because fundamentals demand it, but because positioning does. When too many participants are leaning the same way, leverage, confident, and early, the market must remove them before it can move forward. This is not punishment. It is clearance. The crash was not an accident. It was not a malfunction. And it was not evidence that the thesis was wrong. It was the mechanism by which the market reset itself. Leverage had built up over months. Traders had layered positions on top of positions, assuming volatility would stay contained. Stop losses clustered. Margin sat thin. That structure could not survive a mechanical event. So it broke. The forced selling purged excess. It expelled weak hands. It transferred exposure from impatient capital to patient capital. This is where most people catastrophically misread what happened. They assume crashes are bearish. They are not. They are selective. The crash did not destroy silver demand. It destroyed silver positions. There's a profound difference. Once the paper flush completed, the market was cleaner, fewer leveraged longs, fewer fragile holders, less vulnerability to cascading liquidations. What remained was more durable. And this is why the dip was shallow relative to the fear narrative. The selling was intense but brief, because someone was waiting. Not traders chasing momentum, not algorithms chasing volatility, but buyers with checkbooks and warehouses. Industrial users stepped in. Strategic buyers stepped in. Sovereign accumulators stepped in. They were not reacting emotionally. They were executing plans. For them, the crash solved a problem. It created liquidity at a moment when supply was otherwise inaccessible. It allowed accumulation without bidding the price vertically. This is why the rebound began before the headlines caught up. By the time commentators were still debating causes, the metal was already changing hands. The crash was the final shakeout, the moment when the last illusion of abundance was tested and failed. When a market exhausts leverage, drains inventory, and survives a forced liquidation, it doesn't drift back to equilibrium. It snaps toward it. Repricing doesn't happen because investors become optimistic. It happens because the old price can no longer clear real demand. At first, it's subtle. Dips get bought faster. Sell-offs fail sooner. Volatility compresses upward. The paper market tries to reassert control, but it's working with fewer tools. Inventory is thinner. Short exposure is heavier. And the buyers left standing are not sensitive to price the way speculators are. They're sensitive to access. Silver is trading at $77.98 right now as of Thursday, January 8th at 5:26 p.m. Eastern. That's down from the recent high of $82.58, but it's holding well above the panic lows. The rebound is already underway. Once you strip away the noise, the verdict becomes unavoidable. What happened was not a failure of silver. It was a failure of structure. The price collapse did not signal collapsing demand. It did not signal excess supply. It did not signal the end of a cycle. It signaled a collision between mechanical rules and physical reality, between paper leverage and industrial necessity, between policy intent and market plumbing. The rebalance was real. The selling was real. The volatility was real. But the interpretation was wrong. This was not a market rejecting silver. It was a market being forced to clear positions under constraints it could no longer hide. Every component that drove the crash was temporary. Index mechanics are finite. Margin flushes exhaust themselves. Stop-loss cascades end once they trigger. What remains after those forces pass is the truth. And the truth didn't change. Silver is still required. Silver is still scarce. Silver is still being protected, stockpiled, and consumed. The law didn't reverse. China didn't reopen exports. Factories didn't cancel plans. Inventories didn't refill. The crash did not resolve the imbalance. It exposed it. And once exposed, there is no returning to the old equilibrium. From here forward, every dip must compete with industrial demand. Every sell-off must overcome physical scarcity. Every attempt to push price lower must first create metal, not contracts. And that cannot be done with fear. The crash was not the end. It was the last reset before repricing. I am the Asian guy. The brokers called and told you to panic. The paper market flushed and told you to sell. But Shanghai kept paying $90 while New York screamed $76. If you sold during the crash, you provided liquidity to the exact players who manufactured the fear. If you held, you survived the last mechanical shakeout before the market realizes that paper promises cannot substitute for physical scarcity. Remember to like, subscribe, and share this with someone who needs to understand that the screen turning red all at once was not a warning. It was an opportunity. We're closer than they want you to believe. Stay informed. See you in the next one.